You've heard the some summary of the Beige book. You heard that it was based on data collected up to February 24th. Paul McCulley, what would the Beige book have sounded like if it were up through yesterday?
I don't think it would have been a lot different. I think it would have been tilted in the risk direction. But I think it's important to understand that the economy was in a good place at the beginning of the year. Not robust growth, but good, sturdy growth. And monetary policy was in a good place as well. And we got hit with a shock, a material shock. And I think that the incoming data flow and, most importantly, Fed policy is reflecting that material shock. So I think I'd like to give a hat tip to Mr. Powell.
So, Torsten, let me bounce off what Steve said, and that is if we're going to take any kind of hit to GDP in the first quarter into the second quarter, it's not bad to be taking it now when the economy on most measures is in pretty good shape, employment growth and so on and so forth. Do you agree with that? And do you think that the Fed did the right thing yesterday?
I completely agree with what Paul just said. I mean, it's very important here to remember that ADP this morning, non-manufacturing ISM, was showing that the economy is still relatively strong. What is a bit worrying in the Beige book here is that it looks relatively widespread. It's not just only in the West Coast. It's not just only in those areas where we heard something up until February 24th. So it's a little bit worrying that it is a sentiment issue across the board. But it is clear that the Fed is trying to do everything they can to get in front of this, both of what they did yesterday. And we also expect that they, at the next meeting, will be cutting again 50 basis points.
Paul, there's a lot of talk about, I don't know, maybe the Nixon question here. What does the Fed know and when does it know it? The idea that somehow they panicked the market by cutting rates. And I'm wondering if you could think about, since you're so good at this sort of idea, what is the Fed looking at here in terms of GDP impact? What kind of outcomes do you think that it's worried about and thinking about here?
I think the Fed's really focused on risk management, Steve. I think all of us are trying to crunch the numbers to try to figure out how many basis points of growth in what sector and so forth. But I think the key thing for the Fed is they know the direction, and the direction is weaker. And they also know that they're below target on inflation. So therefore, this shock is deflationary. So therefore, it's incumbent upon them to ease monetary policy. So I think the first 50 was simply a reaction to the shock, both in the real economy and on Wall Street. And I think they'll probably be a little bit more fine-tuning oriented going forward with further easing. But I think the first ease was really a risk management ease as opposed to a bottom-up bean counting of the impact.
Torsten, I just want to throw at you the latest Fed probabilities that I get from my source from Refinitiv here. 92% chance of a 25 basis point at the upcoming March meeting, and then a 92% chance of another cut in April. So that's another 50. In my book, 50 and 50 is 100. Tyler's laughing. Maybe he has different math than I do. Torsten, what do you think of that? Do you think at least in the near term, in the next couple months, a full percentage point taken off the Fed funds rate here?
Absolutely. And I think if there's one thing that we have learned after the financial crisis is that there are numerous speeches, working papers and reports from the Fed saying that once you begin to see some risks coming in, once you begin to, in particular, deal with unquantifiable risks such as this one, you've got to get ahead of that very quickly. And it doesn't matter that you run out of ammunition. You just got to do it immediately so that you get down. Then you can always reverse that if you want to. But I think that a very important lesson we have learned over the last 5-10 years is that repeatedly the Fed has said, once there are risks like this, we do need to do something. And I think that's why you should also expect them to move, again, in our view, 50 basis points here in March.
Steve, just to go back to what you just said, that there's a 92% chance of a rate cut in March.
Yeah, the March meeting, the one they didn't even have yet.
Right, which the one where they were going to go less
right.
So, but you also, there's 92% chance of a rate cut in April. Does that mean a 25 basis point cut by April? So in other words, it could happen in March or April, or does that mean another one?
It could be March or April in the sense that the April contract is bet to close with a 92% probability of an additional 25 basis point rate cut, which, by the way, in my opinion, raises the next question, which is if they've done 50, they're going to do another 50 more. Is it time to start thinking down the road to a zero interest rate again by the Federal Reserve?
Well, that's what I'd like to ask Paul McCulley, because the president has repeatedly made the point that interest rates, in his view, in the United States are way too high and are not competitive with interest rates in other countries, arguing that not only would we be more competitive if we had a zero rate or something very close to it, but it would also weaken the dollar, which would make our exports cheaper. Does the president have a point on that? Is he right?
I think directionally he's right, but I don't think that the Fed really wants to go to zero again. They will if they have to, but I think they would like to stay away from that zero lower bound, because the moment you hit that, then it triggers a lot of other policies that have to come into play. And also, I think it's important to note, and here I would disagree with my friend Torsten a little bit, is they can't reverse whatever they do right now. Back in December, effectively, Chair Powell promised that there'd be no tightening until they actually realized their 2% inflation target. So once they come down, then they're down for the duration until you get inflation back up. So I don't think they want to get too close to zero. I think they'd like to get to or a little bit below where the yield is on the 2-year note and get a normally sloped yield curve, and they would feel more comfortable as opposed to where they are right now. But I really don't think they want to test the limits of conventional policy right now. And if they went to zero, they would, and then that raises the whole issue of QE and monetary fiscal policy cooperation and all of that stuff.
But, Paul, I just argue one footnote to that, which is I think the timing and magnitude of Federal Reserve interest rate cuts is going to be highly contingent this time around on fiscal policy. I really think that I believe behind the scenes, and also I think the whole central banking community in the G7 is going to be pushing hard against the fiscal authorities to step up here. And I think if there's a large fiscal policy package, which I think could be warranted in this case, that you may have central banks, and I think what they want to do is do a little bit less and hold on to the dry powder they may have and let the fiscal side take the lead on it.
Gentlemen, we have to leave it. Go ahead. Final thought, Paul, quickly.
No, I would very much agree with Steve in that we need a fiscal stimulus, no question about that. But I think the Fed would like to have it done without them getting to zero first.